I think today's probably going to be a pretty quick presentation unless you guys have some significant questions, and we'll hold those till the end. But yeah, I think this should be a quick use of your time today. We'll give it one more minute.
Maybe we can take this time to take a nice deep breath. Always feels good.
Okay, I'll just jump in. So we have some interesting news. You may remember in our last call, for those of you that were here or saw the recording, one of the things I talked about was it looked like the Iran conflict should be fairly short. Right now, it looks like that might be the case. I don't know. We'll have to see how the next 2 weeks go and if they can keep the ceasefire. But all indications from what I'm reading are showing that things are progressing positively. If nothing else, the market likes what's occurred. And so that's usually a good indicator, at least in the short term, that things are progressing in the right way. So if things do continue to progress in that way, I think we'll go back to business as usual on the stock market. Oil prices have come down. I think a lot of the assets that have pulled down in price from their previous highs, gold, silver, copper, they're recovering pretty nicely today, and I expect that we'll see those prices go up again as these things settle down over the next couple weeks. So fingers crossed that we keep on this pace. So just a very quick, high level kind of recap. In January, we talked about valuation, how we look at a stock or an investment. We talked about high valuation investing, which is where we are now, where things are overvalued. We talked about low valuation investing and what we will do and do when we get to fairly valued or even undervalued assets. Today, we're going to talk about raising the floor and what that means. Basically, what it looks like if you're all 100% in stocks and what your floor is versus if you have a portfolio that's balanced or even set up for those high valuation investing periods. Number 5, importance of being on the right side of interest rates, why we want to make sure we're invested in a certain way, why we're earning interest rather than paying interest. Number 6, alternative investments. What are some of the things we're currently investing in that give us returns even when the stock market is down? And then importance of cash flow. And so we'll talk about all those as we go through the rest of the year. I'm not going to even touch on these at all. This is a little more detail into what I just said. We've gone over those many times. So we'll skip that today, kind of keep it quick. Okay, so raising the floor and what that looks like for your portfolios. So going back to February when we talked about how we invest when things are overvalued. One of the things that we do is we create a defensive portfolio, one that actually can do well even when the stock market goes down. And the portfolio that we use is an all-weather style portfolio. So this is something that was designed by Ray Dalio, one of the top hedge fund managers in history. And he back tested everything back for the entire history of the stock market. And that's one of the reasons we invest the way we do when things are overvalued, when it looks like there's potential for a big drop in the future. And I still believe that is coming. What's unique about this portfolio and how we create that floor is investing in assets that are non-correlated. Meaning if stocks go down, that doesn't mean gold goes down. It might mean that. It might correlate for a period of time, but overall they're non-correlated assets. Same with short-term bonds and long-term bonds and everything. So you create a mix of assets that perform well during certain economic weather conditions and others that perform well during other economic weather conditions. So, and a big part of that is alternative assets. So, for example, gold and silver, real estate, commodities, things that you generally don't talk about when investing in mutual funds and whatnot. These things, again, are non-correlated, so you can get gains in one area. So a perfect example of this, over the beginning of the year, we did really well in gold and silver and those types of assets. The stock market was going up. So we had a lot of areas where we were doing well. Over the last month or so, those things started to pull back a little bit. But guess what started doing well? Commodities. Why? Because oil spiked up. So those are the types of things why we invest the way we do, especially in an overvalued market. So the other thing that we do is we have cash buffers in our portfolios. So when we see opportunities to make changes or add positions, we don't necessarily have to sell something that we have either a gain or a loss in, or move something to make those changes. We keep our powder dry. We have some available cash to make those changes. So how raising the floor helps you buy more when markets are down. When your portfolio doesn't fall as far during market downturns, you simply have more capital left to invest. So that should make sense as far as the number one tenet of investing. We want to buy low and sell high. So if we're keeping as much available, limiting our downside so we have more to invest when things do become fairly valued, that allows us to shift to those now fairly valued companies and benefit from that downside, buying low. So we anticipate that's coming in the future, and even the traditional 60% stock, 40% bond portfolio, because you do have that exposure to other asset classes. So when market drops, portfolios that chased every last bit of upside often fall the hardest. So one of the things that we see at the end of a bull market cycle is FOMO, or fear of missing out. And you have people extend themselves, either just changing their risk tolerance to something that's far more aggressive than they actually can stand. And that includes starting to leverage their positions, starting to take out margin on their stock to buy more stock. And usually you have what's called a melt up, where the market just shoots up at an unreasonable level. And then the leverage gets called back in and the market starts to come down. And it becomes a snowball rolling downhill. People had leveraged and now have to cover their losses. The more stock is sold, the more people have to cover their losses, the more stock is sold, and it just becomes this snowball rolling downhill that is impossible to stop. Portfolios designed with limit drawdowns lose less. So if we can create a portfolio where we know how much we can take out and we know how much is potential loss as far as downside, as far as the floor, that allows us to actually take out more and be more aggressive with withdrawal rates and be able to outperform the market over time when we erase those downside periods. Losing less means you have more cash, more confidence, and more flexibility, and that gives you the ability to invest more at lower prices. I think that's all pretty straightforward. So here's an example: high volatility, high upside chasing. You have potential for a 40% drop. So if you start with $1 million, a 40% drop drops you to 600,000. What does that mean? You have far less available when the market does hit a bottom to shift from how you're invested to be more aggressive, to buy things while they're low. And if you look at that 600,000, that means 400,000 has to be gained just to get back to even. What does that mean? That's a 67% return you need to get back to even. So you lose 40, but you need to get 67 to break even. If you limit your downside and say you're down 15%, but let's say we have a record down year and you're down to 850,000. You're now down 15%, but you get to invest more into these assets that have declined, theoretically getting a faster return on those assets. But you also need then the 67% to get back to even. In fact, you need about 20% to get back to even. 20% is a far more reasonable return than 67. So it not only does it limit the amount of return that's required to get back to even, it also limits the amount of time that is required to get back to even. And even though the second portfolio might not capture every last bit of upside in good years,
Sorry,
she's apparently having technical difficulties.
I'm having a cat difficulty. I'm so sorry. Literally just jumped onto my keyboard. Oh my gosh.
So even
And
though you might miss out on some of the upside over the next several months or years as the market moves up, you limit the overall downside, the amount of loss versus the amount of gains you're not getting. By the way, you're not sharing right now, Tracy. It's just my big fat head.
I promise I'm working on it. Can you at least see it?
Yes.
Oh my gosh, this cat. Sorry, she turns a year this month. She's a little erratic sometimes. All right, I think we're back.
Okay. So most of the best long-term investment results come from having money available when markets are down. So that's one of the things we're trying to accomplish. Having the confidence to use it. So what we all need to train ourselves to be able to see, at least in the long term, is when the stock market is red over a period of time, that's a buy signal. When the stock market is green over a period of time, that's when you want to be hesitant and potentially sell gains. So that's something that is counterintuitive to what we're taught, what we think makes sense. But as far as investing goes, you want to think opposite of the rest of the pack. And then buying quality assets at a discount. So when things are discounted or at least fairly valued, you want to be buying them maybe even in a more aggressive form than you would typically. So protecting capital isn't just about avoiding pain, it's about keeping your options open. So the biggest gains, Warren Buffett being an example of this, are when you're able to hold the line, know that things, even though it feels like I should be buying because the market is going gangbusters and I'm worried I'm going to miss out, is having cash and capital available for when the dip eventually comes. So that's the big takeaways from today. Any questions about any of that?
Speaking of you're missing out, I see where SpaceX is issuing an IPO this year. How do you feel about it, and is it worth investing in?
I think it's a huge IPO. I don't know exactly how it's going to be issued at this point. I don't know if they're just going to issue a traditional IPO, if they're going to have it be tied to Tesla ownership. I've heard about 500 different ways that they may potentially do it. They may offer it just through a website, which certain stocks have done in the past. So could you buy the IPO and have it go down? Yes. Could you buy the IPO and have it go up? Yes. And probably both of those will occur.
Comment was regarding AI investments. I mean, there are like a couple of major companies now that are just spending phenomenal sums of money. And do you think any of them will survive, or what do you think the future expectations are for AI investments?
Yeah, you broke up there a little bit, but I think what you were asking is in general, with some of these large AI companies and their spending versus earnings, do I think they'll be good investments? So yes, I do think they'll be good investments. They're incredibly, as you said, overvalued at this point. But if you look at the future impact of AI, I think it's worth holding some and being prepared to potentially buy some lower prices in the future. The world as we know it is changing very, very quickly. So back to the original question, I do think AI is a good investment. I think the companies that are involved in it are valued based on future earnings, much in the same way Amazon was back in 2000. In 2000, 2001, you were given an opportunity to get into Amazon at lower prices than when the IPO came out. And so, will we see something similar to that? Maybe, but I think it's worth at least dipping a toe in there, having some exposure to it in case it just takes off, and being prepared to buy more in the future.
Thank you. I yield my time.
Anybody else? Okay, so we are going to be starting a new live that's unscripted where you get to ask me a question. So much in the way we just did. And we're doing it at different random times to try and catch some of the people that can't make it to this call. We will be recording it and we will be answering questions. If, for example, we don't have any questions on the live, we will be taking questions from folks and answering those. And because it's recorded, we'll then send them the recording to give them the answer. So expect an email maybe tomorrow that announces that. You guys are the first to find out. And I hope to see some of you there when we get going. I think that's it from my end. Let's hope all the parties involved in the Iran event can keep things in line, and hopefully we're talking about better things a month from now. Thanks,
Very
everybody.
informative.
Thanks,
Thank you,
Matt.
Matt.
Thanks, Tracy.
Yep.